I'd now like to welcome to the stage Leigh Warner, who's the National Director of Research at Jones Lang LaSalle. Leigh is based in Brisbane and has actually flown down to be with us here today, and he leads JLL's residential and alternative property sectors nationally, as well as overseeing Queensland's research across all property sectors. He has responsibility for coordinating the firm's macroeconomic research and has over 15 years' experience in commercial property. Leigh has held national roles leading both office and retail market research and has provided strategic consulting to private and public sector clients. Please welcome to the stage, Leigh.
I'm going to talk to you about the outlook for markets. So my presentation is a bit wider than the last one, goes quite a bit beyond Sydney and looks nationally at the office, industrial, and touches a little bit on the retail market and some of the trends. But to look at where things are at, I'd first want to stylise how things have been the last few years. So for several years now, investment markets have been leading where the leasing markets have been. Investment markets have been very, very strong. There's been a lot of capital coming into this market globally. There's been strong capital locally, and investment markets have been strong, and leasing markets have been catching up. Leasing markets have been in various stages of this recovery cycle, and some, like Sydney office, are more advanced, some are still quite lagging and at the start of this recovery journey. But this leaves us with a couple of big questions. So when does, now the last few years we've had a lot of returns have been driven purely by the strength of that investment return, driving yields down, and that's driven total returns and capital values. We've all been waiting for those leasing markets and income growth to come through and really drive returns. So the big question is, when does the income return and the leasing market start driving returns, and how long can those investment markets stay at that late cycle mature phase? So I'll try and address those as I go through, but where we are right at the moment, the investment market is holding up. Last year was a very strong year again of investment transaction activity. In the office sector, we estimate, and this is based on the campaigns that Jones Lang LaSalle runs on major assets, there's over $6 chasing every $1 of investment opportunity that's available. So there is a shortage of quality assets, and that is still driving prices in that core office market. We've also seen, and Steve was just touching on it, a big shift towards interest in the logistics market and industrial investment. And there has been strong competition from both local and overseas players for quality logistics assets. So where the office markets are at, office markets are very mixed still. Our regional economies have been very mixed over recent years. Obviously the downturn in the mining sector has hit Perth and Brisbane in particular, and Sydney and Melbourne have done much better over recent years. That is evident in the office markets, and Sydney and Melbourne are strong now. And I'll touch on some of the figures, but last 12 months they've been among the strongest performing office markets in the world. Brisbane in particular, but also Perth, have also turned the corner. And there are signs of recovery, and I'll touch on those trends as well. There's also some strong trends driving suburban office markets. Some of that is the infrastructure that we just heard in the last presentation, and some of it is a change in attitude to the way people are structuring their office requirements and a move to a more hub and spoke sort of model, which I'll touch on as well. In this logistics sector, it's all about, as Steve touched on, the impact of online retailing redefining logistics systems in the country, and this is certainly happening all around the world. And and it's something that we're less advanced in this process, and we have further to go, much further to go in this process. So I'll touch on that trend as well. So I'll start by looking at those investment trends. We track major investments over 5 million. So this is across the office, industrial, retail sector. There was about 28.5 billion of transactions we captured last year in 2017. So that's slightly down on the peak levels of 15, but still the third strongest year that we have on record. So the capital is still there. The investment market is still very strong. Offshore investment is still very strong. So this chart shows the offshore buyers and sales. So above the line in the red shows purchases by offshore entities. Below the line shows sales by offshore entities, and the black line shows the proportion of purchases made that have been by offshore entities. So of that 28 billion last year, around 37% of it was bought by offshore entities and offshore capital. It's potentially more than that because some of the funds driving domestic groups have come from offshore as well. So this capital from offshore has still been driving strong investment activity, and it's still there. I can tell you from first-hand experience, we're still seeing a lot of offshore pension funds, sovereign wealth funds come out here and be very interested in our market. This strong investment market has driven yields in all sectors downwards, and this is what I was saying. We've seen strong capital growth on the back of this, yields falling, and we've seen it in all sectors. So I've got office and industrial, which is a blend of the major markets across the country, and I've also got retail, but I've used neighbourhood centres because that is the most appropriate for this fund that looks to that end of the market. And a neighbourhood centre is your suburban centre with that's supermarket anchored. And it is very different to the retail that is highly exposed to online retailing, because we're still buying our groceries in store, and investors have actually flocked to supermarket anchored centres, and you can see that in the yield compression in this sector. It has been highly sought. From, just to get a little bit technical for a moment, but one thing on pricing that we look at is the spread of those yields above a risk-free rate or the real bond rate. So this is really showing us, because bond rates are low, those yields have actually followed bond rates down lower. And when you look at that spread over the bond rate, even though yields are at record lows, those spreads are not at record lows. Those spreads are actually still relatively okay. So they're not flashing danger, 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 don't invest. They're still saying, well, you know, all asset classes have had appreciation. Property still looks relatively good compared to other asset classes. From a demand perspective, we still have very good fundamentals in terms of growth among major countries, but particularly population growth. And this is another important trend driving that interest in logistics, because at the end of the day, population growth is driving a lot of industrial demand. It drives demand in all property sectors, but our strong population growth, it's far stronger than nearly all other OECD countries, all other developed countries. This is a strong engine of demand for our sectors. From an e-commerce perspective, our penetration rate of internet sales as a proportion of total retailing is low compared to many countries. And this is why many, as I was saying before, we're early in this journey, and this is why a lot of people are looking towards that industrial sector and the restructuring of the distribution network as a strong investment moving forward over the next decade or so. As I mentioned before, we're still buying our groceries largely in suburban centres. So from that retail perspective, there's parts of retail like electronics, fashion that are highly exposed to that online threat. But there are those parts that are non-discretionary spend that we're going to spend anywhere that is not as exposed to this online threat. And this has been recognised by investors and, as I said before, those neighbourhood centres that are anchored by supermarkets have been particularly highly sought of over recent times. In terms of this reorganisation of logistics, some amazing things are happening in this sector in the way that logistics operations are structured. Bringing technology into this process, automating the process, and really redefining where you want to be, the type of facility you want to be in, and even how many staff you need to fund that. So this is an exciting space. This is happening all around the world, and as I said, it's something that has a lot further to go here in Australia. So in terms of this demand picture that I'm painting in terms of redefining the logistics, the strong population growth, some of our industrial markets have started to respond to this strengthening of demand with supply, particularly Sydney. And Sydney has also seen an impact from the residential sector. You've seen a lot of supply in that airport precinct that has been converted to residential uses, and that's pushed tenants out into the western parts of the city and the outer central west. And it has, together with the stronger population growth and these new logistics facilities that are being required, it started to really translate into stronger development activity. Melbourne is starting to pick up, but at the moment this year looks around average, but last year was a pretty strong year. Brisbane's a little bit behind in this process, and Perth has been a little bit weaker. But there's some positive signs in Brisbane, in my part of the world as well, that things are improving in this space. For office markets, I touched on this before, there's a big dichotomy between how markets are performing around the country. Sydney and Melbourne are very, very strong. You see Sydney sitting at just over 5% vacancy now. It did benefit from a lot of stock coming out of this market for some of those infrastructure projects, the metro project that we just heard about. But demand has been strong as well as that supply being withdrawn. So now we're in a situation, there's still no supply for a couple of years. So this market's going to remain tight for several years to come until that new supply reaches the market. Melbourne similarly has tightened. It's got a little bit more supply coming through the pipeline, and I guess it will, its vacancy will move out a little bit earlier, but it's still strong and it's seeing rental growth and it's a strong market. Brisbane and Perth have been very soft over recent years, and after the mining boom, there was a big collapse in demand. Things are improving though, and you need to dig a little bit deeper into these markets. So I'll take my own market, Brisbane, as an example. You look at that overall vacancy rate of 15%. It's still staying relatively high, 13, 14, 13. But if you break this down a little bit more, you can see that a lot of the vacancy is sitting in older secondary stock. So this breaks up that vacancy between prime stock, which is premium and A-grade quality stock, and secondary. Secondary vacancy is sitting at 20%. Prime vacancy, which is the area where Charter Hall's assets would all be, if I'm correct, Steve, that is now down to 7.8% vacancy. So it's much closer to where that Sydney and Melbourne market is at. So there's stories within stories here, and you need to understand that in terms of looking at the investment landscape across the country. There is also this re-emergence of the hub and spoke model that I touched on earlier, and we've seen some big tenants reorganise the way they're structuring their office requirement across the city. So quite a number of organisations are taking the approach of having a very quality centralised space requirement, and then having service hubs throughout the city that it's easy for some of their staff that are in other parts of the city that's easier to access to use on a permanent basis, or 2 days a week or 3 days a week. But instead of just using their own space, an emerging trend has been to use third-party space, or so-called co-working space. So there has been an explosion of this around, and it makes for some large companies planning your future space requirements quite a bit easier, because you can commit long term to your core space, and then you have a project comes up, you can use this co-working space to manage that through the cycle. We've also seen technology enable people more easily to work off-site, at home, in airports, cafes, and so forth. So the office model is changing. And this is one factor that is supporting suburban office demand at the moment. And we've seen some big companies, like I've mentioned there, make quite significant commitments to Parramatta, Macquarie Park, and some of these regional hubs here in Sydney. In terms of rental growth, if we have a look across the markets, there is a strong outlook in Melbourne, Sydney, but also an improving outlook across the other countries. So we're forecasting pretty solid growth in net effective rents across all markets over the next few years, from 2018 to 2021. Similarly, across the industrial markets, we're forecasting pretty solid rental growth again through the next couple of years, particularly Sydney, Melbourne and Brisbane. For the retail market, one final word on retail. I've talked about how the suburban neighbourhood centre is doing okay. Other parts are struggling with that internet threat. And this is evident in this data. So this shows, this is a survey we do. We manage a lot of property across the country as the property manager. And we survey our property managers and we ask them, how much incentive are you offering tenants to secure a new lease? And what is evident in this is that it's become more polarised. More people are offering no incentive whatsoever, but also 20% or more has grown. So at the two ends of the scale, things are going up. And this is what's happening in retail. Retail is splitting. There's winners and there's losers. And as I said, certainly the neighbourhood centres are still performing quite solidly. The really dominant big destination centres are also performing quite well. It's a lot of the stuff in the middle that is starting to struggle. So just recapping on some of my key themes, the investment market is holding up and the office market is mixed, but there's a bit of convergence going on there. The other markets are starting to catch up to Sydney and Melbourne, but Sydney and Melbourne are strong. And there is this groundswell of increased interest in the logistics sector and some of those drivers long term in that market. So going back to my initial slide, what will happen the next few years? Well, I think we will have more growth from in returns coming through the income side as leasing markets improve. We will see particularly, and it'll be at different paces across different markets across the country, so it is important to know the local conditions in each of the markets, but we will see income growth do more of the driving. In terms of the other side of things, there's no reason why the investment markets can't stay strong. Interest rates aren't going up anytime soon. The wall of money from overseas is not going away anytime soon. And unless something unexpected upsets the apple carts, we're likely to see a stabilisation. And these investment markets can stay at a mature stage of the cycle for quite a few years yet. So that's me. Thank you very much.